My name is Paolo Sironi. I am the Global Research Leader of IBM Institute for Business Value for Banking and Financial Markets. I'm also co-host of Breaking Banks Europe, the European edition of Breaking Banks, the #1 Fintech podcast worldwide, and I'm author of literature on Fintech innovation, digital transformation, and economics. My latest book, that will be published by Wiley at the end of this year, is titled Banks and Fintech on Platform Economies, Contextual and Conscious Banking. That is the core of the presentation today. In the pre-pandemic era, I had the chance of traveling the world continuously, and I think we can simplify the world into three macro areas without wanting to forget anybody. The United States is where digital technology was born. The Chinese are becoming very competitive, but largely speaking, we can say that this is born in the US. Europe is where a lot of new regulation is born these days. The Europeans have to integrate the capital market union and have a focus on protecting the final consumer and investor. But Asia, China and India in particular, is where the fintech revolution is winning, because that is where the business models are born. So my role is to understand the variety of business models that cannot all be exported as they are from Asia into the rest of the world. Understand how technology can scale them up, but keep them all inside the regulatory framework in a way that they don't fire back and they generate sustaining innovation for society and the community they want to serve. I think the picture is very complex. I love this picture of Lauren and Hardy, which is a very old comics. If you are my age, you may remember that. Hardy is sick, basically is the patient. And we are in 2008 at the start of the global financial crisis. The central banks intervened, the doctor, to save the patient, but at the same time, they put a cast on the leg, and therefore Hardy cannot move that fast. The legacy systems are also dragging Hardy to the floor, while the fintech are pulling Hardy, the patient, trying to make more dynamics in the industry, but this is not possible. And the regulator is coming, checking that the bank took the pills, the recommendations that are required by regulators in order to regulate the financial services system. Now, it is important to resolve this confusion that every one of these actors understand what is really going on: the central banks, the regulators, the fintech, the banks, and the providers of technology. And this is the scope of the presentation today, that basically will indicate 3 lessons learned from the last 10 years of fintech innovation, where this confusion was not resolved, and the solution out of this into contextual banking and conscious banking platform strategies. That is effectively the core of the presentation today. So by and large, which are the 3 key lessons learned of the last 10 years of fintech innovation? Well, first of all, there was too much focus on disruptive innovation, which is tactical, and not enough understanding of sustaining innovation, which is strategic. And it is very important in financial services, being a regulated industry. Contextual banking, and in particular, conscious banking, are sustaining innovation that will enable well-informed financial institutions and fintech to box out from a low-margin environment and being capable of fighting back the action of big tech players. You see, disruptive innovation is primarily about simplified products and upper volumes to generate margins. But sustaining innovation is about creating differentiating value. And this is very important for banks because they start the digital journey with a disadvantage compared to the non-banking player that have many more touch points with the final consumers. The second lesson learned, which is actually the core of this section today, is the concept of symmetry and asymmetry in financial services. Basically, many did not understand that digital technology, your mobile phone, is a technology of the demand. I call it pull technology. Typically, you go there because you know what you're looking for. When you go on Amazon, you know what you're looking for, by and large. But most of the banking products, especially those that matter going forward because they contain more margins for the industry, operate in an offer-driven industry. Basically, banking is a push industry. So the question is how to put a push industry, an offer-driven industry, onto a pull technology, a demand-driven technology. The third lesson learned is about the fact that many focused in unbundling financial services, although we must realize that on internet, on digital, only platforms win. And therefore, the core is to learn how to bundle back financial services around ecosystems using platforms in order to orchestrate different interactions among the various participants. And this is the biggest shift that people need to understand when they create a new venture, is a shift from output economies, the old linear world of selling products, towards outcome economies, helping clients to fulfill their personal, entrepreneurial, or financial goals, basically building a financial wellness that enables them to achieve their scope in life instead of buying individual products. Now, why does this matter, especially thinking in terms of the difference between symmetry and asymmetry? Because misunderstanding this element disallow a lot of fintech innovation to generate value for the entrepreneurs and the communities they want to serve. If you put on the axis the products of a banking group, let's say to simplify payment, borrowing, investing, and insurance, and you move from left to right, you move from very symmetrical products like payment to very asymmetrical products like insurance. I explained to you this way: payment is symmetrical because you know the value you get when you buy a product, or at least the perception of that value. Therefore, there's no surprise that the biggest players in fintech today, most of the unicorns, operate in the field of payments. It's very symmetrical. People can onboard on digital without much concern. Borrowing is already less symmetrical, a bit more asymmetrical, but still it plays on the left side of this equation, is more pull demand driven. I'll give you an example. If I tell you to go to my personal website, thepsironi.com, and click on it, and by clicking, I will give you $1,000, zero interest rate, zero commissions. You can give me back the money whenever you want. I'm sure that most of you will do that. You will be happy, but I will have a huge risk management problem. So now you see, since you get money, you tend to understand that the value of the relationship. You get money, you can buy your house. But the moment you move further right, you enter into more asymmetry, therefore more clearly offer-driven businesses like investment. If I now tell you, go to my personal website, thepsironi.com, and click on it, and you will give me $1,000 that I will invest on capital markets, for sure you will check on LinkedIn, ask your friends if Paolo Sironi is a person that knows how to invest money, because you will not trust me at the very beginning. And therefore, you see, asymmetry starts to play a game. And that's the reason why a lot of robo-advisors wanted to disrupt financial services, but they didn't manage to do that without heavy investments that only the big players like Charles Schwab, for example, or Vanguard could afford. And if you move further right, you land onto insurance, which is one of the most asymmetrical elements of the financial services industry. To give you an example, to sell you life insurance, I need to tell you that you're going to die. And this is not an easy conversation to be done on mobile technology. Therefore, what is important today is to understand either how to make people capable of pulling asymmetrical offers on digital, or how to make digital capable of pushing to individuals. Now, this second can only happen if artificial intelligence becomes deeply and truly conversational, recreating that relationship element through voice that creates the trust and the, if you like, trusted relationship between two individuals. Artificial intelligence is growing in prowess and in capabilities, but I wouldn't say that this is a feasible goal in the next 2 or 3 years. So right now, what really matters is to make sure that you enable clients to understand that the financial services offers using also artificial intelligence on digital technology, so that they become capable of self-directing themselves. In essence, many have been talking about the concept of data-driven banking, but I think they're looking at the picture of the swan upside down. What matters is to understand first and foremost how to use data to enable clients to understand that the financial services offer using either contextual banking, starting from a non-banking perspective, or conscious banking, remaining visible in front of clients, so that clients are capable of self-directing themselves. Only thereafter, data-driven banking starts generating value, because clients are already capable of understanding the value propositions, and therefore you can use data in order to further increase and improve the experience of the individual client on their life journey using a fintech innovation type of solution. So then, knowing these lessons learned, how can we box out from the current situation that does not allow most of the proponents of fintech innovation to generate value that move them into a different context where they can effectively compete with the big tech player and not only run after the margins, but create new sustainable margins out of their businesses? Well, this is about contextual and conscious banking. Now, first of all, I want you to listen carefully to Mario Draghi, because many think that technology is basically what is disrupting financial services. But in reality, the disruption comes from within financial services as the business model of banks today and some of the fintech that wanted to replicate banks on digital are not apt to operate in the current macroeconomic conditions made of very low interest rate and high cost of capital. So what matters is to learn how to adjust the business model to the digitalization of financial services. So this is what Mario Draghi said 1 or 2 weeks before he left office as the chairman of the European Central Bank. And I want you to listen carefully to his speech because it's really revealing.
Banks would like to have positive rates, unquestionably. So whenever they have negative rates, they don't like it. But I wouldn't go as far as saying that negative rates will cause the collapse of the financial system, because before getting there, one has to look at other things of our banks. For example, the cost-income ratio. Many of our banks have cost-income ratios which are completely way off any average indicator, both in Europe and even more so in the world, if compared with other banks in the other parts of the world. There are certain structural weaknesses in the banking sector, more pronounced in certain parts of the Eurozone than in others. I think these sort of considerations affect much more than negative rates, banks' profitability, banks' capacity to lend. The necessity to adjust the business model to the digitalization, to the changes in technology, is something much more compelling than being angry about negative rates.
So basically what he said is that we need to start changing the business model so that it corresponds under the new macroeconomic conditions to the digitization of financial services, to the digital era. Now, we therefore need to understand what are these business models. And before we dive into those definitions, I want you to look at this slide. I'm trying to represent the journey of a financial institution today towards what I would call the bank of the future using fintech innovation around the 3 axes, so 3 dimensions. First of all, it is important that financial institutions slide upwards on data towards open ecosystem, open banking, opening their data coffers. And they need to do that in a way that they can trust and people can trust data and the usage of data. In any case, they need architectures that enable to do that. And therefore is the cloud platform's emergence that facilitates the sharing of data and the sharing of insights using open banking and open finance type of interactions. On the other side, we can have another axis that I call trust in AI. That means plugging in artificial intelligence in all processes and help the financial institution to transform from product centricity to client centricity. So output economy towards outcome economy. And this is about trusting the usage of artificial intelligence and the AI-driven decision-making. I would say that this is a communication axis. So the vertical is an information axis, data. The horizontal is a communication axis. So the transparent decision among clients and financial institutions. Now, understanding how to slide upwards and rightwards enable banks to make another step, a step forward towards new services, the creation of trusted business models that have to operate on platform economies. Therefore, it is important to understand the tension between information, data, communication interfaces to generate new business models on the platform economies. Now, this is also the core of a paper of the European Central Bank that was published in July 2020, titled Financial Intermediation and Technology, What's Old and What's New, that I invite you to read because it's very interesting. 1 year before this paper, I presented my fourth book, Financial Market Transparency, in the press room of the European Central Bank that discusses a very similar topic, focusing on the value of communication, transparent communication. Now, the researchers of the European Central Bank say that superior information and communication enable financial intermediaries to exert market power. So what is the tension between information and communication that they debate about? Well, information is about core infrastructure, core banking, which accommodates payment and the adverse selection mechanism, basically the credit function. And we know that it is very difficult to generate value out of lending operations because of low interest rate in many jurisdictions and high cost of capital. And at the same time, payments is becoming a very competitive environment, in particular in constituencies like in Europe, the margins are very low, very reduced. This is very demand driven. Now, the core banking side of the banking business also accommodates most of the cost, which is about the legacy systems. On the other side, we have instead communication, which is about interfaces. That is where Fintech innovation tries to make most of the advances. So it's about, in any case, the offer-driven businesses, because today interfaces are primarily dedicated to sell investment products and insurance products. Is about the relationships and is about the information asymmetries. Now, that is where most of the return on equity come today for financial institutions, but the limited amount of investment is available because most of those investments and costs are still dedicated to the maintenance and evolution of the core banking elements. Now, what banks have to do, and therefore Fintech have to focus, is a double strategy that enables them to generate more value out of information and learn how to generate value out of communication. Now, to generate more value out of information, they need to build banking as a service, basically open banking. So facilitate the insertion of their data and insights inside different non-banking adjacent ecosystems in order to transform the way they allow users to consume symmetrical products. Now, this is now directed to consumers which are already fairly self-directed. I remind you what we said before about the credit function and payments. On the other side, they have to build banking as a platform type of architectures, which enable them to bundle back into a visible bank a variety of offers, which is typically directed to the relationship-oriented businesses, those on the right side of the asymmetry of information line that we presented before, in particular investment products and insurance products. Both banking as a service and banking as a platform enable to generate two platform strategies that ultimately will converge to generate higher business value. On the left side, I have contextual banking. So banking as a service evolves into contextual banking platform strategies that make the bank invisible inside non-banking ecosystems, and therefore uses non-banking relationships, which are very symmetrical, to start inserting more asymmetrical products and relationships in between the bank and the client. On the other side, we have conscious banking, where the bank remains visible and basically is a transparent relationship that generates a new type of mature banking or trusted advisors. So then you see, it is a tension between information and communication, core and interfaces, that explains the emergence of banking as a service and banking as a platform to generate new platform strategies that I name contextual banking and conscious banking that enable financial institutions and the well-informed fintech to box out and compete with the big tech players on platform economies. And I like to represent the same concept of this one on this graph, which is what I call in this new book, Banks and Fintech on Platform Economies, the banking reinvention quadrant. On this quadrant, you see two axes. The vertical axis is the information quotient, and the horizontal axis is the communication quotient. And you see two types of areas, gray areas and blue areas. The gray area is about traditional banking and the prima facie digital banking. And the blue areas are about contextual banking and conscious banking, which are positioned on the higher right, further right corner, which is where there is more higher business value. Now, green and blue also correspond to two different concepts, the one of output versus outcome economies, and the one of push versus pull. Now, what is output and what is outcome economy? that I mentioned before, but I didn't truly qualify. Well, output economy means BMW wants to sell 1 million cars next year. Outcome economy means BMW wants to mobilize 1 million people in Berlin to commute in the morning to go to work. Everything changes, especially the way people pay for the services. In financial services, to simplify, output economy means a bank wants to sell 1 billion worth of asset under management of a monetary fund. Outcome economy means instead that the bank wants to help 100,000 customers to achieve their personal, their business, or their financial goals using a contextual banking platform strategy or a conscious banking platform strategy. Now, you see that by learning how to increase the information quotient from product and services, linear value chains through closed ecosystems into open ecosystems that are underpinned by banking as a service enables banks to box out and reach out a higher value space made of contextual banking. This is what we see particularly in Asia. You can think about what happens in China with players like Ping An, SPD Bank, or Bank of Baroda, SBI, All in One in India, or DBS marketplaces in Singapore. On the other side, you have the possibility for banks to increase the communication quotient, which is also part of the contextual banking, but in particular is where the conscious banking emerges in the shift from pushed type of business models to pooled type of business models. And that is where conscious banking emerges and boxes banks out of data-driven distributions into transparent intelligence. Basically, the customers are enabled to be self-directed on conscious banking platforms, following their life journey, consuming financial services, understanding effectively the incentive, the cost and consequences, and therefore they will be inclined to pay for these services like client fees instead of product embedded commissions, which is the other transformation from product to services that is occurring today in the way banks are asked to be paid for those products and services. And this is basically the emergence of conscious banking. Where do you see this? Well, in 2008, at the height of the global financial crisis, some institutions had to start changing their business models. For example, UBS and Morgan Stanley, they did that not much on digital. They're now progressing on digital, but they're really transformed from products to relationship, asking clients to access freemium offers and then tiering their solutions for those which are more sophisticated, but basically moving out of the remuneration inside product and landing on the remuneration inside relationships. Some sort of an Amazon Prime where you pay the fee for the relationship with your financial institution. But you can see the strategy of Goldman Sachs. If you want to look at the last 2-3 years of fintech innovation, Goldman Sachs is trying effectively to move out of investment banking and to land into a different type of institution, basically transforming the business model and digitizing at the same time. So the one of conscious banking is a very competitive space, especially in the Western world. But ultimately, both will have to converge because in any case, banking as a service means inserting financial offers inside non-banking ecosystems in order to reduce the frictions of these ecosystems through platform engagement. And conscious banking is about building banking as a platform where you also bring inside banking non-banking solutions like payroll, for example, in order to enrich the value proposition for visible banking. So the two, if you like, from an architectural point of view, are going to converge, even though the final business strategy is slightly different because contextual starts from non-banking while conscious starts from visible banking relationship. Now, before closing the presentation today, I want to represent this concept because last year I worked with one of the most digital Chinese bank, SPD Bank, which is the 8th largest bank in China, to build for their board of directors the concept of panoramic banking. So the question was, how can banks compete with big tech companies? Well, they need to become super apps, of course, platforms of platforms, but they need to make sure that they generate value for their customers, the customer they want to serve. And the value for the customers, if you think about, for example, the value of an SME is basically to improve the success they have with their businesses. Therefore, you cannot create a solution of that targets one side of the ecosystem without aggregating the rest of the ecosystem. So if you build an SME type of platform, you need to make sure that you also enable to connect the interest of the final consumers. And therefore, we identified a platform strategy which is based around 3 levels. One is the omni-intelligent connection, which is, if you like, the fusion of the banking as a service and the banking as a platform type of architecture that enables to target the omni-business. You cannot create only one marketplace like real estate and travel, because your customer that looks at real estate is also a customer that might want to travel. So it is important to generate value that can be remunerated in the end on platform economies, to make sure that you can understand at the very beginning how you will be able to bundle all of the client journeys of your final clients or their clients into a single platform. And therefore, the last layer is the one of omni users, basically that facilitates an individual to access a platform looking for the realization of different scopes and different goals, whether this is education, travel, housing, or healthcare. And this is what is called panoramic banking or holistic banking, if you like. In any case, the emergence of the super app, which have become a very hot topic in the last 1 or 2 years. And this is definitely underpinned by open banking and open finance, because the more you open the data, the more you understand how to use artificial intelligence to generate value, the fastest you can land onto this type of conceptualization. In any case, what I wanted to tell you is that the 2 most advanced and emerging platform strategies today that will enable banks and fintech to box out of the current linear value chain concept of digital banking are named contextual banking, where the bank is invisible, and conscious banking, where the banks remains visible. I thank you for having attended my presentation today. This is the QR code of my LinkedIn profile. You can scan it and reach out on LinkedIn, where we can continue the conversation. And I invite you to look at my website, thepsironi.com. You see all my literature, and very soon you will also find it there and on Amazon, my new book published by Wiley, Banks and Fintech on Platform Economies, Contextual and Conscious Banking. Thank you.